Okay. All right. Hi, everyone. Welcome to our workshop, our training workshop. Really happy to see everyone here today with my colleagues at Conductor Solar, and I see attendees are starting to sign in to the webinar. So we'll spend the first couple of minutes doing some introductions and letting folks get settled. You're attending our 2-hour training workshop on solar proposal best practices for commercial and industrial sales. My name is Autumn Long. I direct the Appalachian Solar Finance Fund, and I'm very happy to be co-hosting this webinar today with my colleagues at Conductor Solar. Um, I'll give you a brief overview of the Appalachian Solar Finance Fund before turning it over to Conductor Solar for the remainder of our time together. Um, the Appalachian Solar Finance Fund is a regional based financial and technical assistance program. Our goal and mission is to catalyze solar development in coal impacted communities in central Appalachia. We work in 147 coal impacted counties in all 6 central Appalachian states as designated by the Appalachian Regional Commission. We provide grant subaward funding, technical assistance cost support for pre-development, and a wide range of repayable financing and credit enhancements through our partner Invest Appalachia to solar projects on nonprofit institutions, on public institutions, and on small commercial businesses that are anchors in their local communities. So we're really pleased to partner with Conductor Solar to provide financial analysis for our program. And we've worked together to identify some needs based on our experience working with developers, especially in Central Appalachia, about ways we might be able to work together to improve developer experiences and results with solar proposal development. And Conductor Solar, being an expert in the industry, is a great trainer and host for this workshop today. So thanks so much, team at Conductor Solar, for putting this together. I'm going to turn it over next to Mark Palmer for some introductions and background about Conductor. And for attendees, I'll be monitoring the chat and the Q&A. If you have questions, you can type them there. And if we don't answer them live, I'll make sure they get to the right person. So take it away, Conductor team.
Fantastic. Thanks, Autumn. Mark Palmer, good to meet everybody. I'm founder and CEO of Conductor Solar. And just brief background for myself. I always come at solar projects from a development and financing angle. Spent some time in the utility scale market working on the large $100, $200 million solar projects, and then shifted focus 7 or 8 years ago back down into the middle market of these small kind of couple $100,000 to a couple $1 million project size range, even as small as, $10, $20, $30,000. What we realized from a Conductor Solar perspective is that financing for solar projects is so much more accessible than people realize, but it really revolves around finding the right partner for the right project at the right time. And that changes. It's a constantly changing environment. And so when parties are working together on projects that both sides are eager for, it increases the odds for success tremendously. So we built a software marketplace to help parties find each other and work together through financing for commercial and industrial, as well as community solar projects. Also, I'm the Solar Finance Fund review coordinator, the main point of contact from the Conductor side with the Solar Finance Fund. So I've had the privilege of working with Autumn and team for a couple of years now in that capacity. And my job there is to review every proposal for grant funds from the Solar Finance Fund to make sure it's a vetted project, that it will actually move forward and get built, and that actually needs the capital to be built. But we aren't here for any of that. So why we created this course is because in a lot of those reviews from projects around Central Appalachian region, and we work with parties nationwide of contractors and developers. We see a lot of proposals, and we see some that are really good, and we see some that are really bad, and we see a lot in between. And we realize that there's just some best practices that we thought it'd be helpful to crystallize and articulate for contractors and partners out there that we work with. And we hope everybody can get something from this course. We're also a NAPSEP partner, and so being able to offer NAPSEP continuing education credits for this was really important for us as well. We think it's a nice reason and kind of an added benefit for this material. So that's everything I've got to say. I'll hand it off now to James, who can introduce himself before he gives it to Aaron, and that'll really drive this discussion today.
Yeah, good morning or afternoon now, everybody. I've been working in solar since 2008 and infrastructure financing for 30 years. And most of that time in solar, I've been working with, and what I really love about what I do in the industry is working with small to medium size contractors who are developing and building projects, and often need to bring in sources for financing or just an overall comprehensive tax and economic discussion with their customers. So love what I do, have a lot of experience across loans, PPAs, leases, and then other forms of financing. So look forward to bringing that out in today's proposal. And with that, Aaron's going to lead things.
Thanks, James. We'll talk to James quite a bit later as we dive into proposals. A brief overview of me. I've been in the industry almost as long as James. And besides C&I work and finance work, I spent 5 years at Energy Sage, which many of you may be familiar with, the online marketplace, mostly for consumers, including C&I consumers. And not only did we present customer information, but we saw many proposals there as well. So I've worked with installers and EPCs across the country on their sales and channel management. And I'm really excited today to be able to share some of the things we know and I think are really important in analyzing economic information, presenting that information, and putting together proposals for customers. Our agenda today is split up into these sections. Just to give a high-level overview, we'll look at how to analyze electric bill savings, some of the terminology there, how to think about it, ways to make judgment calls about forward-looking rates. Then we'll dive into economic analysis of solar energy projects. We have a framework that we want to share for this that may be familiar in some contexts, but we take a certain perspective here that I think will be helpful for some of you. The next topic is solar project incentives. You're probably familiar with the investment tax credits, SRECs. We'll talk through these and kind of how they fit in the framework, and how to think about them in the context of project finance and evaluating economics. We're going to look through the typical financing types in C&I, cash purchase with loan, leases and PPAs. Talk about the structures of those, what they really mean, and then also why customers pick one or the other, and how that works for C&I customers in particular. And then the latter part of this is going to be about proposals. What should be in them, what shouldn't, what should you highlight, how to think about presenting that information and setting the right expectations with the customer throughout the sales cycle. So that's our agenda. The logic here is that you can't analyze C&I project economics without understanding how much the customer will save on their electric bills. You can't make sense of the incentives for the customer without a good economic framework for that analysis. And all three of those first ones apply to every project. But a great proposal really needs to align with the best financing option for the customer. So we'll cover that before getting into proposals in more detail. Some of these topics may be more familiar than others, depending on your background and experience. And we're going to ask a question about that in a moment. But if some of this is old hat, I would encourage you to find the nuggets that are new or anything we've missed or represented in a way that doesn't fit your experience, because we're always looking for feedback on this material. Each of these sections will be about 10 to 15 minutes until we get to customer proposals, which will be a meatier chunk near the end there. We'll pause between them for Q&A on clarifying questions, but hold larger topics for the end, for the last Q&A there. But feel free to jump in anytime on the chat with questions and let us know what you're thinking. A couple other logistical notes before we get started. We'll share these slides in a follow-up email, so don't feel like you have to take notes on everything that's already in here. We'll also follow up with directions for NABCEP credits and getting that record of completion for those who need it. But at this time, I actually want to turn it over to Autumn to have a poll for the audience about kind of where you guys come from and your level of experience with CNI and with financing.
Thanks, Aaron. I'm going to launch this poll now. We would love to hear from attendees, and we've got 3 questions in this poll, so please do take a moment to answer them. Okay, thank you. I see answers beginning to roll in. So I'll leave this poll open for a few minutes. And Aaron, you're welcome to move on while the poll questions get answered. It looks like we're getting there pretty quickly.
Sounds great. We'll pause again for one of these at the end of this first section here too. But to dive in, the first thing to think about is determining the electric bill savings for the customer. This is really at the core of any customer proposal and the value proposition for them. The first thing to think about here is what an electric bill looks like and what the components of that bill are made up and how they are affected by solar energy produced on site behind the meter. So the first 2 of these are the ones that are often overlooked. Fixed charges are charges that the customer has to pay every month, regardless of how much solar they have on the roof or their property, and regardless of how much energy it produces, because it's always the same: $50 a month, $20 a month, $100, whatever it is. And that's something that we need to take out of customer savings from the start. Demand charges are another category, which is charged per kilowatt, and it's a function of how much the customer uses as a maximum draw from the grid at a particular time period. They can get pretty complex. That one's interesting because sometimes it's impacted by a solar energy system, particularly with batteries. Sometimes it's not, and it depends on the timing of the customer's usage and their demand from the grid and the timing of energy production on site. So sometimes that gets impacted, and it's not really clear at the first blush how much necessarily. But another thing to pay attention to that's different from all of the volumetric charges that we usually associate with customer energy bills, like the energy supply or generation that gets produced by whatever sources are on the grid, the delivery, transmission, and distribution of transporting that energy from its source to the customer's site, typically also in dollars per kilowatt hour. And then there are other volumetric charges associated with programs and all kinds of other stuff, which is directly impacted by solar, because when you produce it on site, you're not drawing more kilowatt hours from the grid. So these are the typical categories that we look for in bill analysis to determine how much the solar PV is going to impact the customer's electric bill, how much money they're going to save. Where does the customer electricity go? This is getting a little bit more into newer rate structures beyond typical net metering. If you look at this last slide, and you have traditional net metering, every kilowatt hour that gets sent to the grid is about the same value as the kilowatt hour that comes into the grid at any time of day. But things get a little bit more interesting now with newer rate structures. You have a different price sometimes for what gets exported to the grid versus what gets imported from the grid. And we'll talk about that on the next slide. So traditional net energy metering, grid export equals grid import. It doesn't matter what time of day, whether it's going or coming, energy is energy, and it's at the same rate. A little bit of background on this. The reason for net energy metering and why it became so popular is because it was feasible with the meters that existed at the time for that policy. We had simple electric meters that could spin forward or backwards. And if you said, well, it's all the same value, it's an easy way to measure it and have solar customers compensated for the energy produced on site. As meters have gotten more sophisticated, it enables other things. And also there's pushback on this policy for a variety of reasons. In addition to differences between grid import and grid export, There's also now differences between the time of use or when the energy is delivered. And this is particularly prevalent in California, where something called NEM3 is in place now, which both has a different rate for compensation between imports and exports, and also has different rates depending on the hour and the season. So you can't take for granted that a kilowatt hour is a kilowatt hour. It really depends on when it's happening and which direction it's coming from the grid or to the grid. And I say not quite NEM here because this is actually sometimes referred to as net energy billing, with that difference between the import and export rate at the retail rate versus the wholesale rate. What that means is that the retail rate is what customers usually pay for a kilowatt hour that's delivered to their property. The wholesale rate is what utilities usually pay a power plant for generation in another location. It's significantly lower than the retail rate and not compensating customers as much as the retail price of energy. So, given all that complexity, how do you calculate a customer's savings? And how do you tell them what they're going to save when they put solar on their property? A couple of facts here. There are 8,760 hours in a year. Each hour can impact demand charges or time of use rates. So you don't have to be in California to have to deal with some of this. Battery storage systems and complexity add some complexity by shifting the time of production versus consumption, because with a battery, you can produce the energy during the day and use it in the evening or the night. But you need to know what that's going to do for a customer's bill. We're going to highlight a common tool here in option 1 called Energy Toolbase, which has a subscription fee of about $200 a month. When you've got complex rate structures like the ones I've described here, this is a very helpful tool and saves everybody a lot of time. There are others in the market, but this is the one that's the most complete and comprehensive and is kind of the standard for CNI. So we recommend it for complex rate structures. The other option that we see often is spreadsheet analysis, which is actually very helpful if you have a simple rate structure. If you have traditional net energy metering, you can break out those different types of charges and do some analysis. You can also do more complex analysis this way because customers can get data from their electric utilities with hourly amounts. You can also get solar hourly production forecasts. But even if you have those 8,760 data points for both of those, you still have to make sense of that in the context of utility rate structures and what the price is at different times or what the demand charge is based on that usage. And it gets terribly complex. So again, helpful for simple analysis, but not recommended for more complex rate structures. So one other concept that we want to highlight in this section is called the avoided cost of power. We talk about this as a per kilowatt hour value, which is a function of the savings the customer has in a year divided by the total system production in a year. And we, in our software, we actually allow people to enter either of these. But this is a very, very helpful metric because it's not just what the economic benefit is to the customer. It's also the price to compare for a PPA or for a loan or a lease on an ongoing basis. And we'll get into that in a little bit. But if you have a tool like Energy Toolbase that will give you the annual savings and you have the system production from Helioscope or from another analysis, you can calculate avoided cost of power in a dollars per kilowatt hour manner. And we also use this to account for all of the complexities that I just described. Grid exports, grid imports, changes in demand charges. You can adjust the avoided cost of power based on those analysis and the electric bill savings implied by those changes. Very rarely is this actually just the customer's total electric bill divided by their total kilowatt hour usage. That's an analysis that makes sense only if they have traditional net metering and every fee to them is based on a per kilowatt hour volumetric charge. It does happen, but very rarely, particularly in CNI. So you have to account for the more complexity of bill analysis when you're thinking about calculating the avoided cost of power. So everything that we've talked about so far is in the past. This is backward looking. You look at a customer's historic utility bill. You think about what the changes would be based on that historic data. But of course, when we're proposing a solar energy system, we're really proposing changes in the future. And that involves looking into the future, which I introduced with this figure. Some of you may be familiar with from the Harry Potter series. This is the Professor Trelawney, an expert at divination, who can occasionally tell the future. The reason this is my one attempt at humor, by the way. The reason that I show her here is because this is really about predicting the future and thinking about where utility rates are going to be. We know our predictions are going to be wrong. They're never going to be accurate precisely, but we can do some things to make them directionally correct and defensible when we're presenting economics to customers and other stakeholders. So one of the things we can do is, of course, look backwards and say, well, what are the historical utility rates in this area? That is helpful. I have some data suggestions for where to look for that information, but it's really important when you look and at what period you're focused on when you consider historical electricity rates. This example shows a 7x jump in the annual escalator, depending on the period of years you're looking at. And we put this together for an article we wrote about a year and a half ago. But it's a good illustration of you're looking at the last year or last couple of years can be very different than the last 10 years, for example. So how do you pick? We'll come back to that in just a second. Here's why it's important. Very small changes in your utility escalation rate can mean huge changes in the 25-year savings that you calculate for the customer. This illustration has a 3% growth rate in blue versus a orange growth rate, a 6% growth rate in orange. And you see by year 25, a doubling almost of the amount of savings. And you can see inside there, the volume represents the total savings over that period. And so making some small changes in percentages can make a lot of difference for how much we expect the customer to save. People have gotten in trouble by juicing this in the past, to put it bluntly. When you take a very aggressive utility escalation rate and tell the customer that you're going to save hundreds of thousands of dollars, you can get in trouble. And so we want to highlight this as a point of contention and provide some guidance as to how to do this in a defensible manner that also supports the sales process. Expect scrutiny because of this. It's not just customers that care about this, it's their advisors, financial advisors, accountants, it's the regulatory agencies that look at our industry. It's financing parties who might be lending to the project or providing incentives. Everybody's going to be focused on what you're representing to the customer here and whether it's reasonable. General guidance for making this reasonable is using historical realities to kind of bound the escalation rates. We looked at how tricky that can be depending on the timing, but those should be some general guidelines. Certainly making the assumptions transparent and clear, qualifying these numbers as an estimate, expected, forecasted, projection. Those are all very important too for saying that this is not a fact. This is what we think is going to happen based on historical realities. But to be more specific, this is what we did at Energy Sage. This is what I say all the time, and I've never gotten pushback on it, so I'm going to recommend it here. 10-year trailing EIA averages for utility rate escalation. Now, why do I say that? The Energy Information Administration is a very boring and conservative government entity that tracks data. And when you use that as your source, most people say, okay, that's reasonably conservative. He's not being too aggressive. I get behind that. 10 years is a long enough time horizon. You can smooth out some short-term fluctuations. And it doesn't matter for customer savings in the sense that there's still significant customer savings using this kind of a escalation rate. This isn't what you have to do, but it's what I recommend based on my experience. And with that, I think I'll pause for a second to see if we've gotten any clarifying questions about the material in this first section on determining electric bill savings, or if Mark or Autumn or James want to chime in with any questions themselves.
Aaron's doing all the heavy lifting to set it up for the easier stuff that I get to talk about later, so I appreciate that.
You're welcome. All right, well, if we haven't gotten any questions on this section, I think I'll keep us moving. Mark, did you want to chime in?
Yeah, I'll just say that oftentimes, I think the most common that we've seen is people just use a flat 3% number without any real support or background for it. which generally has, I think it's rooted in some historical fact, but being a little bit more tied to the location, if you can, is always helpful. We're also coming up in an environment now where utilities are starting to have massive rate hikes, 40-50% increases. And I think it goes back to Aaron's question about, or Aaron's idea about, taking just the last 2 years versus the last 10 years and helping people understand that it's, there are big jumps and there are little jumps, and they all add together to some, reasonable growth rate. And so just flagging that as something, obviously there's solar becomes more attractive when somebody's getting hit with a 50% increase on their power bill for a number of different reasons. But just flagging the importance of the data and the source of the information, just to provide credibility with the customer and somebody who's looking at that is goes a long way.
That's a great point. These recent hikes really complicate this in some ways, because you can look at this chart and say, okay, yes, there was, say, 1.5% for several years, and then all of a sudden it's 10%. But is the future going to look like 6% or 3%? And it's actually a reasonable question. And, of course, we don't know. But it does pay to be a little bit conservative here and to have something that's bounded by a longer historical reality than to just take a 40% rate hike last year and project that into the future, for example.
Yeah, actually, Aaron, I'll step in with a comment. Excuse me. So I've sat with hundreds of contractors in a range of states and had this conversation. And if there is anybody from Hawaii on the line, you can essentially, disregard all of this because you know that your rates fluctuate basically with the price of oil largely. And what I've observed is if your sales conversation comes down to a detailed debate with the customer over whether you're using too high of a rate escalator, it's probably going the wrong direction for you. And so the way I like to sort of flip that is talk with the customer, and they will usually identify their own view of how much their utility rates have been going up. And frankly, sometimes, they're going to have a shorter term memory. So if you're in California, all of our IOUs have raised rates over 10 to 15% in each of the last 2 years. Is that sustainable for the next 25 years? Probably not. But if you ask the customer to kind of lead that conversation, you can avoid getting into trench warfare because you're trying to sell a proposal with 3 or 4 or 5% rate inflation that your customer doesn't believe. So my note from a lot of conversations nationwide, especially in the Northeast and Midwest on that topic.
That's a great point. Yeah, thanks, James. All right, we'll keep going here. The next section that we are going to focus on here is how to analyze the economics of solar energy projects. And we have, as I mentioned, we have a particular view of this based on our experience in project finance and working with a number of stakeholders to clarify what these things are and what they mean for any given project. The framework is actually really simple, okay? We have construction and we have operations. During construction, we have sources of funds and uses of funds. During operation, we have revenues to the project and expenses to the project. Now, I'm using accounting financial language to describe a solar project intentionally because this is one of the most important things here that I want everybody to take away from this webinar. And that's, if you can think of the solar project as its own entity, as an independent business with its own capital and operating budgets, you can think about selling that business to the customer if they're buying it or with cash or buying it with a loan, or contracting with that mini business if they're getting a PPA or a lease. But either way, the way to understand solar project economics is to think about the project itself as a business, and your job is to communicate the economics of that independent business. Now, this is literally the case because a lot of these are LLCs, but whether or not it's incorporated on it as its own entity, this is a very helpful way to think about a solar project and the economics involved. So within this framework, we can categorize anything that impacts solar project economics. Under sources of funds, maybe there's cash that goes into paying for the construction, could get a loan for it. You may have a PPA investor that is actually providing all the capital. There's the federal ITC. We'll talk about that and grants and rebates a little bit later. But all of those are sources of funds that you use to fund the construction of the project. Uses of funds, the EPC budget and its components, a fee for a developer in some cases, if it's independent from the EPC, interconnection upgrades. There are other things that you can itemize, but essentially these are the ways that you use the funds to build the system. Once the system is up and operational, it is receiving revenues. For a customer, that's their bill savings. That's the revenues to the project, right? Because they're not paying for electricity like we described earlier. If it's an independent project owned by a third-party investor, there's PPA or lease revenue to that project from the customer paying for their monthly invoices. If it's a community solar project, there are subscribers. SREX is another ongoing incentive that is a project revenue from the moment of operation going forward. Similarly, there are expenses for operating and maintaining the system, insuring it, replacing the inverter after 10 years, 20 years, depending on the inverter and the warranties, repairs that inevitably come up. And if you have a front of the meter project site lease, that's not our focus here, but it is an expense with those projects, community solar or small utility. In any case, these are things that you have to pay for going forward. And on very small projects, these expenses are almost negligible. It's almost like residential where you can kind of set the system and not worry about it unless your installer calls you or you notice something going wrong. But as the system size gets bigger and the system gets more complex, it's more work to maintain it and more costly to maintain it too. So these things tend to receive a fair amount of scrutiny. But that's the framework. And we'll come back to this in a second. To use this framework, I want to show an example of what we often see in solar sales proposals that we find troubling. We'll talk through what this presents and why we would do it differently. Okay, this says you have a total system and it costs $1 million to build. Great. You get a federal investment tax credit of 30% of the value of that system, $300,000, and that's deducted. Okay. You get an inverter rebate upfront as well. That's $50,000. And that you get SREX as well, and that's $200,000. So your system cost net of incentives is only $450,000. Now, from a certain perspective, this is true, right? These are incentives associated with the project, and that could be thought of as the net cost of the system. But what this implicitly communicates to a viewer, as a customer, I look at this and I say, oh, I get $1 million system for only $450,000. That's great, if only. So this is what actually happens. You build the system for $1 million. So that's $1 million out of pocket. You get the rebate 3 months later, $50,000. And so your net cash out of pocket is $950,000. 6 to 12 months later, you get that ITC back from the IRS. And so another $300,000, you're down to $650,000. Year 1, year 2, year 3, you're getting $20,000 in SREX every year, more or less, because those are actually production incentives based on the system's actual production. But for now, let's just say that's what you get. You're 3 years in, and you're still have out of pocket much more than that $450,000. What this view of project cash flows highlights is the importance of thinking through who's going to fund construction. Will the customer monetize the investment tax credit themselves, or do they need to do that differently? Does that affect the value of it? When will the customer receive all of these incentives? And those SREX, are they really fixed, or are they variable based on production? This is a much more accurate presentation of what the project economics look like for a customer. And it also elicits a lot of the questions that you have to ask when you're thinking through how they're going to finance it and pay for it. And that's why we find this misleading as a presentation and this much more accurate. Let's see. I'm going to pause.
Aaron, I'll chime in on that real quick on the last slide. This is something that we see pretty often, this discrepancy, and Aaron touched on a number of different items here. It's particularly true with the direct pay path for nonprofits, in the sense of when the direct pay comes in. Most organizations seems now to be educated that they understand the direct pay amount won't come in until after the project is built, and they need to somehow bridge it. But some of them are caught off guard and don't understand that this isn't an upfront funding amount. So unless the solar contractor is going to float that float that kind of bridge loan for the customer, which we don't recommend. But we understand that could be a great sales strategy if you've got that kind of cash flow. Being very clear about that. And then some other pieces on the SREX is another thing we've seen is rarely there are options where sometimes you can sell, on behalf of your customer a strip of SREX for the next 5 years and get a certain price. Maybe sell them for all 15 years, the rights to the SREX to some party and get a fix up front, dollar per watt DC. But most of the time, these are based on market-driven forces that will ultimately ebb and flow the value of the SREX. And even in this presentation, that doesn't really come across clear as that could be $20,000, it could be 15, it could be 25. And so anyways, it's just a couple of things to highlight so that, I think as I think about a solar contractor, a big part of business is referrals and people feeling like they got what they bought and they got what they were sold. And so making sure they feel like that, not just upfront and on year one, but also year 2 and year 3. So just trying to be precise about, what's assumed and how they can do this and whether or not you'll support them, are some different angles to consider as well.
James, Autumn, anything you guys want to chime in with here? I've got one thing that I'll highlight. Oh, yes, please, Autumn.
No, not yet. Go ahead, Eric.
Yeah, we do have one other question asking what about MACRs and bonus depreciation? Like, where does that fit in? And it looks like James is
I was going to type an answer to that, but it's
okay.
a good question, so I'll answer it because this is a great segue from a point Aaron made. If you think about the business as its own, if you think about the solar project as its own business, then changes to tax policy and specifically depreciation really impact that. So in a few slides, we're going to talk more about the importance of depreciation, but this is sort of a methodology question. So with the preface that we do not provide tax advice, and you should put that on every one of your proposal pages, the concept at the federal level is that we had bonus depreciation enacted in the tax reform from 2017 that meant you had 100% bonus depreciation, meaning you could write off 100% of the depreciable basis of your system starting in 2017. Now your depreciable basis, buckle in, I'll do this quickly, but we can come back to Q&A later. Your depreciable basis is the price of your system minus half of the federal tax credit that you take. So for the longest time, everybody hard-coded this in their models at 85%. Obviously wrong. In my lifespan here, we've had a tax credit from 26% to 40%, maybe 50%, whatever. So whatever that tax credit is, take half of that. So in a 30% scenario, your depreciable basis is 85%. That's input one. Federal bonus depreciation says you can write it off on what's technically called double declining balance, which is 5 years, but technically that means you get some half years in there. So it's really 6 years. Look up the formula for that. The key point, and you can easily Google this, I checked, is that that bonus depreciation level is now stepping down. And I believe it's currently at 60%. It goes to 40% next year and 20% in 2026. That means you can depreciate 60% of that depreciable basis, and you can depreciate the remaining amount over a standard double declining balance schedule. So it's 60% plus something like, depending on what schedule you use, 30% of that additional portion on a schedule. And then apply all of that. And this is where with the tax credit, the customer's marginal rate doesn't matter because it's a dollar for dollar credit. With depreciation, it does matter. So you're taking that depreciable basis times the amount you can depreciate times the customer's marginal federal tax rate to figure out what that value for depreciation is. I'm sorry if I answered too much, but we can come back in the Q&A if there was not enough detail in that response.
That's great. Yeah, we'll talk about depreciation again in a moment. We let that out here to simplify things. And I'm going to highlight something else that we simplified that some of you may have caught. Back here, I told you that the federal ITC and upfront rebates are part of the sources of funds for construction. And here I told you that they don't pay for construction. So if you notice that discrepancy, I noticed it too. The reality is that the cash flows year to year are a little bit more complex than just a simple operating versus construction breakdown. And we generally think about things that happen in the first year as part of the upfront budget, because the rebate and the ITC are not elements of the ongoing project. They happen once at the beginning because the project was created. However, that doesn't mean the cash flows happen before construction. So construction finance is something really important to pay attention to, and we'll come back to that again in a little bit too. Next
Aaron,
up,
I'll just
yeah,
chime in that we saw Taylor sent a question on REAP grant funding. We'll touch on REAP grants here in a subsequent slide.
Yep. So, in fact, right now we're going to talk about incentives. REAP grants are one of those. And these are things that varieties of organizations provide to support solar energy projects. And they take many different forms, but they're very important for the economics. The federal ITC is the big one, and we're very grateful for the Inflation Reduction Act for making it stable for a long time. It's calculated as a percentage of the project's cost or an appraised value if the project is sold early on. The baseline is 30% of the value. And then if you're in an energy community, you have a 10% bonus. If you have domestic content, you have a 10% bonus. And if you're in a low to moderate income territory, you're providing that, you get 10 to 20%. So these things can stack up to a significant portion of the project's costs, but there are some caveats. It's important to note that your customer is responsible for stating this value to the IRS and justifying it if needed. Their CPA may not be a solar expert, so they may take your word for it. But if the IRS audits the amount and deems it unallowable, your customer is going to be very, very unhappy. So we want to be accurate in representing ITC adders to customers, and whether they are possible or whether they are certain. So specific to the adders, energy communities are determined on a map that the DOE provides, but they change. And the project geographies may qualify at one point in time and not another. And this needs to align with the project's construction timeline. Now, not all of energy communities' adders change. Some of them do. And we can go into the details there if we want to. But it's important to make sure that the location aligns with the energy community's adder at the time the construction starts, I believe. Is that right, Mark and James? Okay.
Yeah, after you finish, Aaron, I'll go through in a little more depth on the energy communities and domestic content.
Great. These are two that are in flux, and we're seeing a lot of changes recently. The industry is also working out what qualifies as domestic content. So the legislation required manufacturers to disclose a ton of information about their costs to be able to qualify for domestic content. And we've gotten a lot of pushback from them on doing that. There's been some simplified guidance just within the last few weeks on this that will hopefully make this easier, but everybody's working through how to factor this in. And nobody has a lot of confidence yet about domestic content claims. We see this from investors buying projects. They'll typically ignore domestic content unless it comes through, but not take it as the baseline for pricing. Similar with LMI adders, because there's a limited capacity and a lottery to get these adders. And you could qualify for one, but it may be a 10 to 1, a 1 in 10 chance that you actually get awarded. And so also something not to bank on or to represent to customers as part of the project, unless it's qualified as something that may come through or a possibility. The ITC obligates the customer to own and operate the system. And they have to do that for 5 years as part of, we call it the tax period, but that's a requirement from the IRS. And so they can't sell it and they can't turn it off. It has to keep going with the same owner. And then if the system is greater than 1 megawatt AC, I believe, prevailing wage and apprenticeship requirements also apply, which can increase the cost of building it and the labor associated with it. So all of these have to happen so that the customer gets the ITC. The requirements at the bottom are for any of the ITCs, including the base and the adders. And then Mark wanted to talk a little bit more about the specifics on energies, communities, and domestic content.
Yeah, thanks, Aaron. I actually don't have too much to add on the domestic content piece. Thanks, you covered it all. On the energy, other than to say, we're not seeing people assume that in a kind of institutional level. yet. We're starting to hear more comfort. We're starting to see a couple institutional level financing providers feeling like they're going to be able to qualify for it with certain partnerships on certain equipment and manufacturers. But it's still, broadly to be a little bit unclear. On the energy communities maps, so the way you can qualify for an energy community is one of three ways. It's based on your project location. One is it can be on a brownfield site. And so a brownfield site, think about like a landfill. I think there's some other technical criteria for defining brownfields. I don't know all those specifics, but the brownfields are on a site-by-site basis. And generally, once a site is designated as a brownfield, it shouldn't change in the future. And so you'll need to understand whether or not your specific site qualifies. And if so, that's a little bit of the harder one to figure out because there's not a map that you can literally put a pin in to figure out where your project is and if it qualifies. On the other two, there's a map from the DOE that's out there. You can type in your address and see if you qualify. The project qualifies as an energy community. It's either due to coal closures, so you're either in or adjacent to an area that had a coal closure in the past, since a certain some year. I can't remember exactly what the year is, but a coal closure. Those energy communities shouldn't ever change. That's a fact that there was a coal facility that closed that qualifies, and those census tracts and projects in those areas shouldn't ever change. Then there's the MSA statistical way that you can qualify, which basically means it ties to a level of unemployment, as well as a level of employment related to energy related activities. I think it's kind of gas or fossil fuels, and then also something tied to your poverty rate and your general income level being below a certain threshold. That's the type of energy community that can change over time, because as census tracts get updated and as poverty rates update and as job percentages tied to fossil fuel industries change and go up or down, those census tracts can change from year to year. They were just changed a couple of weeks ago. Generally, this should change towards the end of May or early June every year, and it really shouldn't change until the next year as new census data comes in. So we've gotten a lot of questions around that recently, and I just wanted to provide some additional context. Apologies on my lack of specifics on some of those details, but I think hopefully everybody understands the general aspect there and kind of things to look out for as you're scoping out projects and qualifying for some of these incentives on the ITC.
Thanks. Yeah, given the focus here with the Solar Finance Fund, my understanding is that quite a bit of Appalachia qualifies, largely because of coal closures. And so I wanted to confirm that with Autumn and Mark, and encourage anybody who hasn't looked at this to make sure they're including this in their considerations, because taking a 30% ITC and making it a 40% is really significant to the project economics. And if you've got one of the solid energy communities adders, it's definitely worth including.
Yes, and on the Appalachian Solar Finance Fund website, which I can link in the chat, it's solarfinancefund.org. We do have a map that layers the federal energy communities map and the low income communities map with our program's eligibility. So you can filter that and see specific location eligibility for each of those three programs, the two federal programs and our program.
Excellent. So another category of incentives here is RECs and SRECs, renewable energy credits, social renewable energy credits, sometimes called certificates. These are production-based incentives, which means that they're given for actual system production in kilowatt hours or anticipated system production with a true-up at the end of the contract period. This is a structure we see in Illinois in particular. These get made as the solar system produces energy, and they're another source of revenue for the project because they can be sold either up front, as Mark mentioned, or on an ongoing basis. And they do have value in many territories. They're also tradable across state lines, and this is something people don't always realize, where you can sell West Virginia credits in Pennsylvania or Ohio credits in Virginia, but they're not available everywhere. Tennessee doesn't have them, for example. But they are a source of revenue and definitely worth including when you think about the project economics of a solar energy system. And it's worth looking into, even if they're small, in states that are not big rec states like Illinois or Massachusetts, or some of the ones that have had big policies. Project grants, including REAP and the Solar Finance Fund. This is cash provided to cover a portion of the upfront cost of a solar energy project. A little bit about REAPs. They have a geographic criteria. They must be installed for an eligible owner operator, and usually that's the customer. It's a pretty big application to get these things through. Many people hire professional grant writers that specialize in REAP to get this done because it's so involved. And importantly, they're not for construction financing because they typically get paid out after a system is built. So you still need to find a way to fund construction, but they can be a significant portion of the project budget. Mark or James, do you have a general figure on what a REAP grant typically covers?
It could be up to 50% of the project costs, and that's not universal.
So that plus the ITC gives you almost the full project in some cases.
Yeah, right now a REAP grant, yeah, it's up to 50% of the project cost. It caps out at $1 million amount that for the grant. So for any projects above $2 million, the maximum REAP grant amount is $1 million, is my understanding.
So we see a lot of interest in using these for projects and finding a way to make this happen. But the challenges are the effort involved in writing it and making sure that you receive it, and also finding a way to finance construction, even if this is awarded. The Solar Finance Fund. Oh,
to speak
ahead.
to Taylor's comment earlier on the REAP grants being hard to quantify. Yeah, they are competitive grants. We typically see people, there's some good banner in the chat on the REAP grant. We typically see solar contractors, some of them hire a REAP grant writing specialist internally if they really want to focus on this. Most of them will have 1 or 2 or 3 that they contract with. And you typically need a month for the application. It's not a cheap application because it is so extensive. And it only covers costs that are incurred after the grant is awarded, is another nuance. So it's not like you can apply for it, start building, and then kind of retroactively apply it if you get it. And so those are just a couple of nuances on the REAP grant, but we do see more and more solar contractors focus on this across the country, especially in light of changes which were made, I think maybe a year and a half ago, that made this whole program a little more value. It increased from 40% grant to 50% grant, and it processes on a quarterly basis. So I think at the end of each quarter, calendar year quarter, so end of March, June, September, December, applications are processed and granted. Whereas before it was only at the end of March of each year. So it just became this slog, and once a year, it just made it, kind of tough to plan around. So those are some changes that have made it a more proliferous offering.
Great. And I should really turn the question about the Solar Finance Fund over to Autumn and Mark too, to describe how that program works and how you can take advantage of it.
Yeah, and I'd be happy to just spend a minute clarifying some details about the Solar Finance Fund. And first, I'll mention, as I mentioned in the chat, that while REAP is available only for commercial entities, rural commercial businesses, or farms, the Appalachian Solar Finance Fund focuses on supporting tax-exempt entities, so nonprofits and public institutions like municipalities or schools or public libraries, any sort of tax-exempt entity. That's where we can step in with grant funding. We generally provide support to up to 20% of total project costs, so not as large a percentage as the REAP grant, but still significant. And we can also support commercial projects in the pre-development phase with technical assistance cost support funding. So for the types of soft costs that get incurred during solar pre-development, whether that is support for a grant writer to complete a REAP application on behalf of your rural business or farm, or engineering and analysis, feasibility studies, utility interconnection fees. We can provide cost support for those types of technical assistance services for rural commercial businesses within our geographic service area. And again, map available on the website. We are currently focused on coal impacted communities within Central Appalachia. So a relatively narrow geographic area, but really focusing on like project impacts in local markets where solar has not really taken off yet. And so our goal is to like really catalyze project development in those local areas.
Awesome. So our last piece here about incentives is a few others, and we'll talk about tax benefits here, and I think come back to depreciation as well. We do see rebates from utilities and state agencies. There are smart inverter rebates, just general solar rebates. There are state tax credits too, for those that pay state income tax. They can take advantage of those. And accelerated depreciation, as James was describing, is a tax benefit that's key, and has been a little bit in flux, as he mentioned. I want to provide some caveats about tax benefits, because they assume that the customer can take advantage of them, which means that they are a for-profit entity that is profitable. Nonprofits and for-profit entities that don't have enough net income to have a tax liability may not be able to monetize them, and particularly depreciation or state tax credits. When you have transferability with the investment tax credit, as we now do after the Inflation Reduction Act, it's possible for a for-profit entity to transfer that credit. They won't receive the full credit amount, but they can receive most of it. And similarly, nonprofits can get direct pay from the IRS for the value of the ITC. The ITC transfers have been slow to get going with smaller projects in C&I and smaller portfolios. It's something we've been working on actively. So you can't assume that the customer can transfer their credit, but it is something that is available in theory and more in practice as we go along, and we'll keep working to try to make that easier for smaller projects. But important to, when you think about presenting information to the customer, qualifying tax benefits appropriately is really important here, particularly for nonprofit entities. But I'll turn it back over to James to talk about this a little bit more.
Right now?
Well, we can come back to it in the Q&A later, too, actually.
I don't know if I already spent my political capital on the tax discussion so far. So I put the double declining balance schedule in the Q&A chat if anybody wants to look at it. But in concept, I'm just going to comment more on the selling side of this. And I'll talk about this when we get into the project examples. Look, in California, where project economics are so relatively juicy due to high utility costs, this level of detail on tax benefits, it's more of a binary question. The customer needs to understand, hey, can they monetize the tax credit? Do they want to? They talk about depreciate. It's kind of like over and done. My experience, I spent a lot of time in Texas selling projects, working on financing projects there. I found that contractors in more difficult ecosystems, or in plain English, states with lower utility costs, got really good at selling tax benefits to the point where they had people who could step in and talk to their customers in detail about Section 179A deductions, which a lot of small businesses may be eligible to take, where you can actually write off 100% of your project costs in year one. Details about how they engaged with the customer in the federal tax discussion. So I recommend, the tighter the economics in your state or based on the type of projects you're selling, more expensive build costs, the better you get and the more you focus on dialing in your ability to talk about tax benefits effectively and your pattern for getting the customer to bring in their actual tax decision maker. And again, the next level insight there, that pure CPAs tend to reject or be very against solar, partially in some cases, frankly, because it's from kind of after their time. And in some cases, because it does ask them to make a lot of more complicated decisions, and they take on more of the role of advisor to the owner. So for a customer that's focused on doing this, though, I would get good about, driving through to talk to their tax advisor and engage in that conversation, because ultimately it's not you. And again, you don't want to provide tax advice, and you want to be clear that you're providing guidance, and they need to make that tax decision. Get good about bringing that tax advisor in. That applies in states like Texas through the Midwest, and where I think a lot of participants are here, where those extra tax incentives, the depreciation value at the federal level is really important, in some cases more valuable than the tax credit itself. And so you want to really dial in your process for talking about that.
Great. So we're at the top of the hour here, and I think it might make sense to take a 5-minute break and come back in 5 and continue. After we come back, we'll look at financing types and dive much more into customer proposals. But for the moment, we'll see you in 5 minutes.
Great, and we'll plan to reconvene at 1:06.
Great. So let's continue to financing types and talk through how most projects get paid for. One thing we want to highlight at the outset here is just how popular financing is in C&I solar. Not everybody sees this because we have different corners of the market that we focus on, but of about $5 billion annually in the US in C&I solar, 75 to 80% is financed with long-term PPAs and leases. And that's on a dollar value basis. The remaining 50 to 20% is financed in some other manner, like cash purchases by the customer, purchases with a loan, a PACE loan, a business loan. Shorter term equipment leases, we see this less frequently. But the story that we want to tell here is just how popular PPAs are. This is on a dollars basis, and if you look at the number of projects, it's not quite the same split because there are a much higher number of smaller projects on the smaller project size. But regardless, this is a very popular option. It's worth asking why. To answer that, first we're going to go through some transaction diagrams of what these financing options are. And I'm going to highlight this as a tool that is very helpful when you're thinking about financing. From simple diagrams like these to really complicated structures like tax equity partnerships. It helps everybody get on the same page when you can actually draw the boxes and the arrows, particularly for anybody new to this. So the simplest, of course, is a cash purchase. The customer pays upfront for the system, the EPC installs the system, and those are the transactions. When you have a loan, the lender is paying the EPC upfront with a caveat because of construction financing and confirming that that's part of that. Many lenders in solar will provide a construction to perm loan, so they do cover the construction period, but it's not something to assume if the customer said, oh, I have a loan for this, particularly with things like the ITC and other things coming in later. The EPC still, of course, is installing the system and the customer still owns it. So that goes to the customer. And then the customer is making fixed payments monthly to the lender to pay for the system, pay the lender back over time. So that's what a loan looks like and the transactions that are happening between the entities there. PPA is a little bit different. Still, the owner operator, like the lender, is providing upfront capital to the EPC. With PPAs, it's almost always the full construction cost, and it's designed to cash flow for the EPC and the customer, meaning that investors, third-party owned investors, are providing all the capital for the construction, for the interconnection, the full budget, including development fees. They won't usually pay for development expenses during the sales process, but occasionally they will come in for limited NTP items that are a little bit earlier than the construction starts, long lead equipment things. And so there's a couple categories that may come in that way. But for the most part, PPAs, long-term leases, are designed to cash flow for the project. And so you don't have to worry about that construction financing with this solution. The long-term contract is between the customer and that investor and owner operator. The system delivers the customer kilowatt hours and the customer pays per kilowatt hour. For a long-term lease, I could change the labels here and the kilowatt hours get delivered and the customer pays per month. and there's energy services agreement, which is another flavor. But these are all third-party ownership structures, long-term contracts where somebody else is owning the system and the customer just has to pay per month for the power that they're receiving, essentially. So those are the financing types. Again, I encourage anybody who has questions about these things to diagram them this way, so that everybody's on the same page with what's happening and what the contract structures are. And this is something you could share with customers too, if you want to later on. What does this look like from a customer's perspective? We're going to take a couple angles on that. At a very high level, thinking about the economics, let's say a customer is evaluating cash purchase loan and a lease or PPA. The only one that has, we're going to also ignore construction financing and assume that the loan covers construction for this purpose. With a cash purchase, it's a lot of upfront costs. Even with most of the incentives, it's a significant investment for the customer and something that they have to consider in their planning and their capital budgets. But of course, they get the maximum energy savings because they own the system and they don't have to pay for the financing. The operating expenses for the customer are limited, but they're also unfamiliar. So they're not typically in the business of owning and operating energy production systems. They may or may not want to take on that, and they may or may not be comfortable with the responsibilities of ownership. We see this sometimes, particularly with businesses and bigger systems. For a loan that includes construction financing, there's not an upfront cost, but there is significant long-term bill savings after the loan gets paid off. There's usually savings upfront as well, and during the repayment period. But of course, after the loan is repaid, the customer owns the system, and for the remaining amount of the system's life, they own it. And that is attractive to some people. But again, it's in the future, right? It's not today. And the same operating expenses apply, and the customer has to own and operate, maintain, and insure that system. Contrast this with the lease or a PPA, where there are no upfront costs, there are no operating expenses because it's owned by a third party, and the electric bill savings are known. Of course, we said before that there's some uncertainty there about how much they are, but typical practice, a minimum of a 10% discount for the customer on their electric bill here, meaning the difference between the amount that they save, their avoided cost, and the amount of the lease or the PPA is 10% for the customer from the start. And then there may be an escalator associated with the contract, there may not. But that's pretty well known, and it's much more certain for a business to take that option as opposed to some of the requirements and obligations of the first two. So from an economic perspective, this is a view on what they see and the relative certainty of those things as they evaluate these different financing options. For a more comprehensive perspective, we're going to shift the axes here. The cash purchase loan PPA carry those obligations that I was describing, depending on whether it's owned by the third party or not. And it's worth thinking through some of these things for a customer. They have to ensure, operate, maintain the sites. If there are repairs, they have to coordinate those, deal with the warranty claims. Many EPCs will cover parts of this with a workmanship warranty, but not always all of it. And then if there are SRECs, reporting for those are also required for the customer. With a loan, they're also paying the monthly loan payments, but again, they own the system and they have to do all those things for it. With a PPA, they have to pay their invoices. They have to provide access to the system owner for repairs, maintenance, those kinds of things. But it's much less involved from an operating perspective for the customer. So to try to answer the question of why so many customers pick PPAs and leases, that's a big part of it, is the difference in obligations. But there are other factors to consider. Some customers don't have the credit history or record that can justify a loan or a PPA or lease, so they're left with a cash option. Some of them don't want to enter long-term contracts, and these are 20, 25-year contracts. Again, they can buy it with cash if they're in that situation. If they have a large tax liability or an easy way to monetize the tax benefits, then of course cash purchase can be great. But if they don't, it's more challenging. And then having somebody on hand to manage and operate the system, or having just a smaller system size that's easier to manage, is also helpful for cash purchase deals, because that means the customer can take advantage of the system and has the confidence to own and operate it. All of those apply to loans except for poor customer credit, because you need customer credit to get the loan. It comes more down to lack of available cash, and a issue that we see with a lot of businesses of having cash on hand, perhaps, but prioritizing their core business and investments there over investments in a solar energy production facility that is not core to what they do. So they often prioritize their resources on their core business and would prefer somebody else to invest in the solar energy system. So with the PPA, or at least no upfront costs, it's off balance sheet, which can be beneficial for a lot of entities. Maybe they can't monetize the tax credits. They also may not have internal funding, or again, are prioritizing their core business with their own resources. For a lot of people, just not wanting to own and operate a system is a big factor here. And then they also get savings today and more stability with power costs for a long time. So there are a lot of benefits. But of course, the economics are better for cash purchase, sometimes comparable between loans and PPAs leases, often better with a loan long term because the customer owns it. But hopefully this rounds out a perspective of why customers would pick a PPA or lease, even if the economics are not as optimal for them in that case. I think I want to turn to James here and see if you have other things that you want to add to this chart, or stuff that I've glossed over.
Yeah, Aaron, one point I want to come back to. So we've talking a lot about how a PPA is really prevalent financing type, and a lot of those metrics end up folding in lots of large, the Kohl's and, large national chains that have done a lot of PPAs at the smaller C&I level. And I can't see the results of the poll, so I'm not sure the states, but I'll assume we have a good portion in lower power cost states. The minimum 10% savings concept you're talking about on a PPA, I want to highlight, that's not a formula. That's a criteria, meaning a PPA will only be offered to customers where we can achieve some level of savings. And from a customer standpoint, essentially no one's going to do a power purchase agreement where they're paying a premium for power. And so that's why we spend so much time talking about how to get, focused on utility rate analysis, tax savings discussion, and we'll talk a little more about project finance economics in a second. So I think I would highlight for partners, contractors, developers on the call, rather than hearing, well, kind of everybody does PPAs, and so that's where we should push folks, is say, actually pulling back from that, the smaller scale systems are financed with PPAs and leases. They're also financed with loans and in other ways. And so it's really saying, well, what's the appropriate situation for our customer? Particularly, there's a lot of chatter about REAP grants in the thread, especially when you get into REAP. That opens up different doors for financing, but makes third-party financing, PPAs and leases, much more complicated, or in some cases prohibitive. So I guess broadly, just don't take from this that the PPA is the preordained solution for every system, especially smaller commercial and nonprofit systems in low power cost states. We have a lot of different ways. And there are some customers we haven't talked about that may prefer to pay part cash and finance part of the system. So we can get into that. But that minimum 10% savings is really a target to be able to sell a PPA. It's not like we can just look at any system and say, great, here's a PPA at a 10% discount to your power cost based on all of the other factors that go into, evaluating the system. So
that's a great point. No, I appreciate that. I mean, I recognize that based on my Energy Sage experience and advising the homeowners from that perspective, there was a lot of emphasis on cash purchase and loan because of the economics. I think one of the things that I want to emphasize here is the difference with Resi and how PPAs are a tool in a different way here. But you're right; these are all viable options and definitely worth considering. I think the other thing that I want to highlight here, a couple things. Depending on which road here, which lane the customer is in, you're going to want to customize a lot of things about your sales process and the materials that you present to them. So we'll talk about that with the next few slides. The other thing is that James mentioned, that 10% savings is a criteria for investors to even do a PPA or lease. So much so that we at Conductor have built an automated system to be able to answer that question. So you can put in project details and see what the rate will be. and whether a project is economically viable. And that's a free resources to everybody. But just to iterate how important that is, it's something that we've automated in our software because it's such a key criteria for third-party ownership and making that a possibility for a customer. Have we gotten any clarifying questions on this in the chat or anything we should discuss before jumping into the next section here? All right. The next part of this is on customer proposals. And for the first few slides here, I'm going to hand it over to James to talk through what we like to see on proposals and why.
Thanks, Aaron. So I appreciate, as I said, Aaron doing a lot of heavy lifting up front in giving you a conceptual framework to think about utility savings. This is, at the end of the day, every solar proposal comes down to this. I would literally say there's no commercial system that gets sold without consideration of utility rate reduction. And so conceptually, just to kind of level set, having seen a lot of these proposals, we'll call it best practices, but I candidly kind of hate that term because it varies from state to state. People have ways of talking to their customers and their customer base that aren't going to be the same. But there are some universals. So I kind of go back to that old who, what, where, why, when approach, which matches up nicely with what we see in what I would call a consistent professional solar proposal. And so you don't need to read the numbers on the screen. I just tossed up some examples, and for reference, for those who don't use Energy Toolbase, the section at the bottom, particularly the bottom right, is the way their software does a really nice job of breaking out the customer bill on a monthly basis and on a time of use basis. So a lot of rates, even outside of kind of the California and the Northeast, will have a different schedule for summer and winter, and then sometimes you'll have time of day. So don't zero in your screen. You're not missing any key content if you can't read the numbers. In fact, even the 3 examples on the page here aren't from the same proposal. I just took what I could nicely fit on the page to highlight. In a standard proposal, I recommend coming in, showing a customer who you are as a contractor, where you're proposing to put the system, then what that system is in summary form, why, meaning how much you're going to reduce their utility bill and their tax payments by, and then I'd include at least some brief comment on timing, which often gets overlooked and is important to customers. So we'll get to the finance pieces here, but the couple points I'd highlight are, especially the bigger the organization and the more people involved, everybody's going to want to see where that's going, and everybody's going to want to understand conceptually when that's going to happen. This is a financial product, and so we sometimes gloss over that, but the logistical pieces of this are important. So pop that layout in there, pop that brief timeline discussion, and then that segues to another point Aaron made, that we talk a lot about what financing is, but there are some things that financing isn't, and that's those development stage expenses and considerations. So when there are those upfront things, you know, the number of contractors say, oh, we'll be on your roof for 4 weeks, you know, let me assure you that's not the typical customer installation timeline. You're going to have a period where you're confirming they can get a permit, utility interconnection, you know, mobilizing and all that. And so just think about those front end expenses. If you're going to have to spend some money to figure out whether this can even get built, for those who are delving into carports, that really comes up when you have an external vendor that wants money for engineering so you can apply for a permit, and it creates a little bit of a circular there of, well, what comes first, you know, the permit or the money to get the engineering done to get the permit. And these are things that are not covered, or at least not easily covered in when we talk about financing. So a typical commercial proposal should include those elements. And then when you think about the timeline, you know, before you just paste in your, you know, your Microsoft project time diagram, think about this kind of upfront considerations for the customer. What's this really going to take? And what are those uncertainties that you may want to talk to the customer about? Hey, are these things you're prepared to cover so we can figure out if we can get the project built, or how you're going to share that risk on the front end? So those are the components. Honestly, there are some great commercial proposals that are, I'll say 1 page, but to be fair, maybe 3 pages with a layout, a utility savings analysis, and a financial analysis. And that's the proposal. And then certainly a lot that have a lot more information than that. So, Aaron, to get back to the financing general topic, I'll leave it at this, but certainly happy to take, questions on commercial solar practices and analysis tools if there's interest.
Sounds great. I expect we'll come back to that in a moment. I think I'll keep going with your examples here, James.
Yeah. You want me to do these?
Yeah.
Okay. So hopefully I made the font on these large enough to pick out and I'm going to touch on, I see some of the Q&A popping up. I'll try to touch on. So I'm going to show 3 financing examples, and I'm going to overlay this with the comment that it's really important for whatever ecosystem you operate in. And while I cannot say I've financed a lot of projects in, Ohio, West Virginia, Kentucky, Pennsylvania, I've certainly touched enough there to say this applies there as well. And conceptually,
Is it me who is glitched out, or is it James who is glitched out?
No, I'm seeing James freeze there as well.
oh,
Hey, you're back.
James, you froze, but you're back.
yeah. Competitors are sabotaging my internet connection, so I apologize. So I'll quickly run back through that just to say, have an intuitive sense of where utility savings is going to be in whatever neighborhood you're selling in. I have some folks who don't want to run an energy tool base or utility savings, or you haven't even spoken to your customer and you want an idea. And so I've taken a few, I'll just say kind of archetypical examples that I'll do here. This first one is admittedly more for California, or if you want to think and you're in New Jersey and you kind of want to think of this inclusive, maybe with, the SUSI incentive there, this is a good example. And then the second one is what I'll call more targeted towards lower power cost states. So the concept I encourage all developers and contractors to think about, we use that term interchangeably, is every project comes down, if you want to think about like a cap rate or a PE ratio, depending on your background, the 2 key things you really need to understand are what's the installation price and what's the customer's utility savings. I look at that ratio, and that tells me essentially everything about the cash purchase economics and the potential financing economics for a system. The higher utility savings as a percentage of your price, the better the overall economics for your system are. So there are 100 ways to calculate payback, simple paybacks, actual paybacks, and all that. Conceptually, they're all driven by this ratio. And so the way I've started this off is to show just an example project here, 200 kilowatts at $250 a watt. So we have a $500,000 project, and assuming the customer is going to save 15 cents on their utility bill. That'll be realistic or conservative in California. That'll be realistic perhaps in New Jersey-ish. And then in some of the other states, that'll be higher. So we'll come to a second example. So in this case, if your customer, and you're talking about the cash purchase, if you assess with your customer all of the tax discussion that we had earlier, and you can boil this down to your customer confirming they can take all the tax incentives, not just the tax credit, but the depreciation, then you can truly talk about that system cost net of tax savings. I just encourage you not to gloss over that, because your customer is going to have to cover that full system price. It's just that they'll pay for the better part of half of the system by simply filing a tax return. And yes, sometimes that will be more than half the system if you have a tax credit adder, or if you're a marginal 35% federal rate payer, or if you can depreciate more of the system and so on. But you can pay for the better part of half by filing a tax return. You're just going to have to sort of bridge that portion. And that's where we talk about payback. So this is rounded off just conceptually. The net cost of the system over the utility savings is about six years, okay? Some folks will say that's a long payback. Some folks will say that's a short payback. By solar terms, that's actually pretty good payback. There was a question in the chat about customers asking for shorter term payback, customers asking for a 1 or 2 year payback, like quote unquote other construction projects. 2 key things to keep in mind here. Solar is a 25-year asset. Those modules are made very well and come with long-term warranties for a reason. So it really orients you to thinking about solar as a long-term payback. If you can efficiently monetize tax benefits and everything else, and you live in a high power cost state, you'll get that down pretty close. We did a lot of projects for Costco where they had a 2-year payback that we could achieve. But trust me when I tell you, a big part of that was being achieved by cutting EPC margins. The second piece is that, well, hey, that's where financing comes in, because you shouldn't think about this if you don't have the budget for a 6-year payback. That's when we transition to columns 2 and 3 here is, hey, is there another way to finance this, even possibly a hybrid cash down plus a loan for a part of the system that could help get you there? So I use this case because a pretty standard loan offering that we'll talk about is essentially a 20-year term where your payment's going to work out to, as you can see from the example here, a little bit less than 9% of the system price, actually right about 8.5% of the system price. And that's presuming that the customer's prepared to make a principal pay down about a year out when they have presumably reduced their federal tax bill on the sort of next tax year, and they've kind of mentally banked that money and use it to pay down principal on the loan. We can get you to a payment that's going to be about 8.5% of your project price. And yeah, there are more loan options around that, but I use that here just to show that's how we get to a project that I would characterize as being cash flow positive for a customer. So specifically for Autumn, the question that came in about how do you get to a shorter term payback is that's when financing really comes into the equation. And I would reiterate here, and I have this little tiny note at the bottom, plus depreciation tax savings. You know, in the loan scenario, we're essentially assuming you're taking the tax credit and applying that to pay down principal. But if you've confirmed that you can monetize the tax credit, and I've put it here at roughly 15% all in, but that's a pretty big bump of additional cash, in this case, $75,000 by my math. That's also your kind of upfront savings on this project. So bring me a customer, let me finance your project. You're essentially not coming out of pocket and you get a nice tax bump in the first year. That can be really effective project economics. And if that customer said, hey, I want to put $100,000 down, we don't have to finance 100% of it. So that gives you a sense of how the loan economics work. And then PPA, you know, as we talked about, the investors taking all the tax benefits. And let me highlight, this PPA payment is indicative for discussion, realistic, but just for discussion purposes on a 20-year PPA with a 0% escalator. With this kind of economics in California on a project this size, we could also get you to a payment that's going to save you a good margin on your net payment. You're saving $45,000 on your utility bill. You're paying $40,000 for power under a PPA. We can get you to some savings here. So I'll quickly move on to example 2, where now we've popped from California to, say, Texas, possibly Ohio, which, as a side note, I am also from Ohio, where maybe we're dealing with power in the 10-cent range. So I've made another assumption here to show the math, which is to make the economics look attractive, probably going to need to have a lower relative install price, or, and this is the big or, be able to sell customers who are prepared for a longer payback period and be very good. In fact, I think I wrote this in one of the Q&A responses, develop a very good insight and banter for talking about tax savings with your customer. The lower the power cost, the more you need to be good at that aspect of the conversation. And so in this case, you know, if we do that similar loan product, even at a $2 a watt system, but with 10-cent power, we're actually going to be a bit cash flow negative on the loan. So then this ties in Aaron's conversation about utility rate inflation. And so maybe your customer says, okay, I'm prepared to go negative, perhaps in the example of that one customer, for a year or two, or if it's a small negative amount, maybe a little bit longer. But I know as my utility rates go up, because that loan payment has no annual increase. Once that's in, that's locked in for, you know, essentially 10 to 20 years. So you've locked in a payment with no escalator, and maybe you're a little negative, but you'll go positive over the course of things. Or similarly, in the PPA realm, most of the underwriters are going to look to make sure you're cash flow positive from the beginning. Part of the way they do a 20-year underwrite is to make sure that customers are saving money. A customer that's saving money is more likely to pay its bill, which is more likely to be a good credit risk for 20 years. But conceptually, this kind of put the project a bit underwater. But if you can sell a project with, say, a 7 or 8 year payback instead of a 5 or 6 year payback, you can still sell that. Okay. But understand up front and perhaps assess. And frankly, there's this, everybody's mantra, right? Is if you're going to get a no quickly. So evaluate if your customer needs a 2 year payback and you just know at 10-cent power, if you can build at $2 a watt, you're not going to get anywhere close. That may not be the deal that you spend time on. But then the federal government gave us this additional consideration here. Could we get example 3, please? So now we pop another energy communities adder into the mix. And we have the kind of conductor view is that by next year, we'll also have a lot more general comfort from the vendor through the financier side on domestic content. So without getting too aggressive, we might even have a 20%, ITC adder world. But in this scenario, that helps to offset a good part of the impact of lower power costs. Do you still need to be tight on your installation price, depending on the cost of power that you're offsetting? Absolutely. But in this case, same numerical example, just with a 40% ITC, customer commits to pay down a little bit more of the project cost after a year, and we can get to a loan that's now cash flow neutral. So that 10% adder really helps. A year from now, if you were in a scenario we had domestic content as well, maybe that 20% or adder actually puts you back to cash flow positive, or gives you a little more room on your EPC pricing on a project like this. And then again, provided the PPA investors comfortable with the energy communities adder, we also get you back into the realm where a power purchase agreement might deliver you a cash flow positive financing. So broad take from all of that is, first thing I look at, I sometimes even call it cap rate, but that utility savings over system price tells me everything that I need to know. If I see that number at 3%, meaning your utility savings is only 3% of your proposed system price, financing is probably not going to be the right option, because even then you're going to have a substantially negative cash flow project. But if you can sell your customer whatever kind of payback period that works out to you, in some cases even 9 or 10 years or more, then you can still sell that. It's just going to put an intense focus on being able to talk to your customer about monetizing the tax benefits and really understanding what their objective is in going solar. When I see that number start to get into the 7%, 8%, 9% range, utility savings as a percentage of price, those are the systems that I know either the customer's going to have an impressive payback, or if we were brought in to do a loan or a PPA financing, that we're going to be able to deliver some positive cash flow, positive margin of savings for the customer in the first year. So everyone get out your glasses. But no, for those who asked, I think the PowerPoint will be available. The concept here is, and I probably should have broken this up, but we do so quick story. I came from investment banking. All of our models were columns with the years across the screen for 10 years, right? You can model a 10-year bond deal. Then I come into this industry where the panels last for 25 years. You got to do 25 years of cash flows. Let me tell you, I rebelled for a long time showing years down the vertical axis because nobody on quote unquote Wall Street does that. But this is ultimately the selling proposition for what we do. You got to take all your pages from landscape to portrait and run your 25 years down the margin. So for the people asking about 2-year paybacks, for real, this is not a lighting upgrade. Go do your lighting upgrades. And by the way, we probably talked to you about financing those if you need to, but that's so effective, you don't need to. This is a different product. They're also going to do HVAC upgrades at some point that are going to have no payback, because that's not how HVAC efficiency works. So when it comes to solar, and this is our standard kind of power purchase agreement, quote sheet, term sheet will show a customer, this is the North Star for your customer discussion. If you could read this font, it would tell you 3 key things that apply to every project we're willing to propose a PPA for, which is we're going to finance 100% of your project, and you're going to pay on a performance basis, meaning you're paying for power produced. If you produce more, your payment goes up. If you produce less, your payment goes down. So the investor is responsible for monitoring and making sure that system performs. And that's going to deliver you positive cash flow. Aaron said we try to target 10%. In some cases, it's a lot more. Those are the 3 things that are going to be part of every PPA proposal. And then beyond that, we're just sort of reiterating, hey, look, here's your system proposal and your price that the developer came up with. Here's the PPA rate we're going to propose your customer. And here's how much money we expect them to save. And then we're going to drag those formulas out for 25 years, folding in Aaron's conversation about utility rate inflation. I ran this at 3%, which is good for California. I'd use 2% in the Midwest and a lot of the Northeast. And that's how much you're going to save over time. So that's ultimately the 25-year story and narrative you need to create for your customers. And I'm going to pause there with the last point is, we don't need it up front, but at some point to take these things forward, we're going to ask every customer, be prepared to share your financial statements to really kick off the underwriting process to make sure you can be approved. So that's to try to, with all of that first hour of heavy lifting, that Aaron did and how we kind of pull this in to bring specific lenders or investors in, this is the culmination of that narrative and how we try to talk to your customer about financing.
Aaron,
I'm not sure what's on the next page, so I'll be surprised as well.
Sorry, I was muted for a second there. James, am I right that most contractors and EPCs in practice will take this page and or these 2 pages and put it alongside their kind of cash purchase proposal with all the details that we looked at earlier?
While I don't know what they do, I'll say this is intended to be a supplement to whatever your standard commercial proposal is. Certainly folks who have a great template they like, it's made to be easily portable. But if nothing else, it's made to crisply communicate and review the value proposition. Because actually, I'll make one broad point too. A lot of conversations start off where somebody goes, well, hey, why don't you talk about financing? And it's important to get the order right. So there's a baton we have on every commercial solar discussion, and that's set up with the sort of who, what, where, why, when questions, with that utility savings really being the key. A lot of customers understand this. We do this every day. Whenever we hire a new person, I always tell them, remember what today's like, because every customer, it's their first day on the job in solar. And so we just spent 2 hours in a webinar talking about this, and I know the impact on the mind. Every customer goes through that. So until that customer actively affirms that they understand how much solar is going to reduce their bill, it's actually premature to talk with them about financing because they're not really sure what they're financing. It's not a construction project, or it's more than a construction project. It's a utility cost savings tool. It's a financial tool. And the customer really needs to affirm, oh yeah, I got that. Or, and trust me, this happens all the time, my bill is $10,000. Oh, this is great segue in my ramble here to another question. Oh, I can only reduce 50% of my customer's bill or 25% of my customer's bill. That's not the key issue. Your customer might want to reduce their entire bill, but some people have small roofs or too many trees or whatever else. If I told you can get 20% off certain items at the grocery store, that's no reason not to take 20% off those items, even if I can't get you a discount on others. I get my ACE coupon. Who gets an ACE coupon? I can take 10% off, but I definitely cannot get 10% off a Yeti cooler. So same with solar. If you can only reduce 25% of their bill, great. Let's get them savings on that 25% of the bill. That's what we should focus on. Whether you use it to propose with this page or your own template isn't the key issue. We want to make sure you understand for whatever kilowatt hours we are offsetting, even if it's a quarter of your bill, we're going to get you a financing or sell you power at a lower cost than you were paying for those kilowatt hours.
Great. There's another part of this that aligns with the question that Taylor asked about the warranties on panels and the degradation and how to handle that. You can see here we've got that at 0.5%, if you can read the font, as James mentioned. And so typically we will degrade production at 0.5% per year. That is a little conservative with a lot of the warranties out there right now. You see them at 0.25%. And so it's, if you have panels that have that kind of a warranty, it's okay to represent it at 0.25% too. But definitely important to factor that in when you're doing projections on production and PPAs.
Thanks, Aaron. I didn't know that about degradation. I'm so old school that 0.5% used to be considered aggressive. And then when SunPower came out and said 0.25%, everybody in the industry said, no way. So. Yeah.
I think 0.25 to 0.45 is what Taylor mentioned is a lot of the warranties these days. I love that the wattages keep getting bigger, the efficiencies keep getting higher, the degradation keeps getting lower. It's a good thing to have. This is a follow-up slide on something that James was mentioning about what to emphasize here and what we're really selling to customers, because proposals include a lot of information, and it's important to give them a picture of what the whole system's going to look like and from a lot of different perspectives. But the core of this is really the bill savings, as we've highlighted several times. And among the many things that they could look at and focus on, usually an activity in sales is bringing them back to this as the emphasis of the value proposition and what that means for them and their business. Similarly, there are specific headline numbers that I like to highlight as kind of anchor points that you want to emphasize for customers. And there are other things that they would typically focus on instead. So with a cash purchase, we want them to see how much they're going to save over the life of the system. It's a huge amount of electric bill savings. We also want to highlight the payback period that James emphasized in his examples when that's attractive. Many times, of course, the customer will be have a little sticker shock with the upfront cost, which can be really big for these systems relative to their budgets and businesses. And sometimes it makes sense for them to invest that nonetheless. But with the cash purchase, those are typical dynamics of kind of where we'd want their emphasis to go and where it goes instead. With a loan, we want them to see the net savings in year one. And as I mentioned earlier, the long-term ownership associated with it, because in most cases, the loan is designed to provide them savings, even though it may be underwater for a few years, as James mentioned in one of his examples. Customers, like all of us, often get stuck up on the term and the rate, thinking about comparing this to a mortgage or a car loan and how do I understand it as a loan. But it's not just the loan, it's also the solar energy system providing the savings. And so net savings is kind of where I like to draw attention back to. Similar with a PPA or lease, because that's the difference between the electric bill savings and the cost of those PPA or lease payments. But customers will often be curious about what happens at the end of the term. Do I get to buy the system out? How much would it cost? Or just figuring out what this thing means relative to a loan, which they're more familiar with. A PPA is a very solar specific or energy specific instrument, and often takes a fair amount of education for customers to wrap their mind about that and what it is. So this is a view of where I like to draw attention and where it may go instead in customer conversations. And just to kind of bring a few things back here, those key headline numbers there are all supported by everything we've talked about today, from the electric bill savings across the board, utility rate escalation, the particulars of the loan product and whether it gets reamortized after the ITC gets paid, and similarly the PPA lease rate and term and escalator. Those are the things that we have to analyze and figure out to calculate that key benefit to the customer that we want to communicate and emphasize in the sales process. More broadly, to summarize a few of the things that we see that we like to highlight in proposals, with the numbers, we want to focus on the most important economic outcome for the customer, which is different depending on their financing needs and their financing preference. We want detailed analysis supporting those headline numbers to be available with reasonable and transparent assumptions. But that doesn't mean we're going to emphasize it and put it front and center. That's a lot of supporting analysis that can be gone to if people want to dive in. We also encourage people to use software tools like Helioscope, Energy Toolbase that we recommended, and our own Conductor Solar. If you're looking for PPA or lease rates to propose to customers, we can provide that in an automated fashion. And again, it's free to use. And then matching the level of precision to the stage in the sales process, which I'll talk about on the next slide. When you look at the whole document, beyond just the economic analysis, as Jane mentioned, pictures of the draft layout so the customer can see what it'll look like, pictures of successful projects from your experience and portfolio, clearly noted as examples, but they can be illustrative in a helpful way. Testimonials from past customers are nice. And as James emphasized, the project timeline and proposal expiration date is a nice one to offer there, where this is a proposal that's good for 30 days or 90 days or whatever you want to make it. And then encourages the customer to take the next step as well, which it's also helpful to outline. Would you like them to sign a letter of intent? Do they need to review a full contract? If they want to take the next step, what is that? And can we make that explicit in the proposal? So in summary, some best practices generally for proposals in CNI. And then this slide is more about when to use proposals. And I'm going to ask James for his thoughts on this one too. When you're prospecting, you're looking for new leads and potential customers. You're trying to identify people that are interested, but you don't need to be precise. You don't need to have a fully baked proposal to figure that out and see if people might be interested in solar. When you're talking to them, having a first contact, you're typically trying to qualify and see if they're a good candidate. And does it make sense to go further in the sales process? Again, you don't need to have all the details worked out and precise, drawing and engineering documents. You just need to try to figure out if this is a good prospect and which direction they might go with financing, for example. And then once you've got them in conversation, you're nurturing that relationship, trying to get traction with them toward the sale. You need to get more precise and you need to have more details to share with them, but you still don't have to have everything until you're really getting to closing and you're wanting to get the customer to commit. And so you need to have something that's more thorough and definitive for what they're agreeing to and signing up for. I highlight this because some sales organizations will put together proposals and throw them to customers and say, hey, you should sign this thing, or this is really good. When it often helps to have a conversation first, identify the customer's priorities and what financing might be the right solution for them, and do some of that qualification before sharing a lot of details that may or may not matter for them, particularly early in the sales process. James, any thoughts on this progression and other tips for kind of managing how to get to the customer to close at the end?
The broad idea I come back to is if you have a gut sense of both your market and like where you build, what type of project you build efficiently, then that should guide your sourcing. So I used to say the best thing you can do to source a project is, look in California or New Jersey or Hawaii or Illinois, where you have the kind of overall highest incentive plus rate structure. But within your market, it's saying, okay, well, great. Deals work where I can build at least 100 kilowatts on a wide open roof and I can hit the right price point to make deals work. But I also know that when I go to carports, it's not going to work. So not to make everybody think that California is the solution to everything, we have a lot of areas of the state with lower power costs. So in Sacramento, where you have 12-cent power, you can't go in there with steel parking canopies and make the economics work. And so I just tell people, hey, look, understand if you're going in there, you're going to have to sell long-term paybacks to your customer. We're not going to make this work from a financing standpoint. But if you have whatever those numbers are for your organization and your market, if you understand what that value trade-off looks like, going in, am I selling a 10-year payback? Am I selling a 6-year payback? Is financing going to be right? And then the part that kind of feeds from that is, do you have a really good banter for assessing a customer's tax appetite to take tax benefits? Last note, I'll just say, don't listen when people try to close that discussion down and go, I don't want to deal with the taxes. You bring an investor to do that. Don't take that at face value, because what they've also just said there is, I don't want the best economics for my project. I want to give up some of the best economics. And so if you run away from that conversation too early, hear them. If that's their answer, maybe that just makes the deal a non-starter. But the more you can keep people in that discussion, that's where we get pretty... I was just doing some math. If you have adder situation at 40%, in some situations, that customer could probably pay for 60% of the system costs just by filing a tax return. And if we get to a situation with domestic content and energy communities, maybe that number's like 70%. Don't write off that tax conversation too early in the process.
So we are through our material, almost at the end of the hour here, but we do have a little time for a couple of questions. Autumn, Mark, is there anything that stands out for you in the chat or other questions that you think we should address while we've got a moment here?
Well, I think we've addressed all the questions that I've seen come through the chat. Thank you all so much for being so responsive on that. I would like to launch a final, just short 2-question poll for our attendees while we open the floor for questions. And we just want to hear from you on a couple questions about utility rates and solar paybacks in the areas where you're working and what you're experiencing. So I'm going to launch this poll now, and I'll leave it open through the end of our Q&A period. And feel free to ask additional questions in the chat or via the Q&A. And I'll turn it back over to the conductor team for final thoughts.
Sounds great. Thanks. Mark, I wanted to let you chime in here too, since James and I have taken up the better part of the second half of the hour, and see if there's anything else you wanted to highlight about proposals, since I know you see a lot both through SFF and through Conductor.
Thanks, Aaron. I don't really have anything else to highlight. I think I'd love to hear, from people, anybody who is attending this. Would love to hear feedback, either directly or to Autumn, things that, you think we covered, just thinking about your expectations coming into this and, did we hit that? Did we do a nice job? Did you learn something new? That's what I'd love to hear. I think generally it's an honor to spend 2 hours with a lot of really smart, interested solar professionals on this call. So thanks for your time and attention and questions. We'd obviously love to be giving this live. That'd be even more fun and engaging. But yeah, anyways, that's it. I'll also throw out the offer of, happy to take a look at anyone's proposal, to just give a quick comments or thoughts in terms of, where there's anywhere we identify that we think could be tightened up or buttoned up for working with your customers, just as an offer to, kind of go back and forth on that and provide some advice on live specific proposals. Not every proposal, to be clear, but one general one to just kind of brainstorm on and strategize for moving forward.
Great. Well, thanks everybody for attending. We'll follow up with emails on both the slide deck here and the NAPSAP certification credits for anybody who needs them. And thank you, Autumn, for hosting and organizing. It's been great to spend a couple hours with everybody today.
Thank you all so much. Thanks to the Conductor team for this great workshop. I learned a lot and had a great time listening in, and hopefully answered a few questions as well. Thank you all for who attended. Hope you found this worthwhile. I certainly did. And we'll be in touch. And please do continue reaching out to the team with any questions that come to mind. We're here to help, and I appreciate you, Conductor, very much. Thanks again for a great time, everyone, today. Bye-bye.
Thanks, everyone. Thanks, Autumn.
Thanks, everyone. Yeah, I'm going to stop my recording now.